Listen to me, people. If you are retired, or if you are anywhere near reaching that beautiful milestone of retirement, you need to pay attention right now. Because there is a hidden tax out there, a stealth tax, that has been flying completely under the radar for too many hardworking Americans, and it is ready to take a massive bite out of your retirement income if you don't watch out. I am talking about the net investment income tax, also known as the Medicare Investment Income Surtax. Now, do not let the name fool you. You hear the word Medicare and you think, oh, Susie, that must be a good thing. It's just a little fee to fund healthcare. No, it is a 3.8% penalty tax on your investments, and it does not go into a private account just for your medical bills. It goes straight to the government. And what breaks my heart is that so many people think this tax is only for the ultra-wealthy. They think, Susie, I'm not a millionaire, I don't need to worry about this. Let me tell you why that thinking is incredibly dangerous for your financial freedom. This tax was created back in 2013, and when the IRS set the income limits for who has to pay it, they did something devastating. They did not index those limits for inflation. Think about that. Every single year, ordinary income tax brackets adjust for inflation so you don't get pushed into higher taxes just because the cost of living went up. And because those limits have stayed exactly the same while property values have soared and portfolios have grown, more and more middle-class retirees are waking up to a shocking tax bill that they never saw coming. So, who actually pays it? This is the core question you must answer today. You are triggered to pay this 3.8% surtax based on your modified adjusted gross income, or MAGI. If you file your taxes as a single individual or a head of household, that frozen threshold is $200,000. If you are married filing jointly, that threshold is $250,000. If your MAGI is even $1 over those amounts, and you have investment income, you are officially in the danger zone. Now, let's talk about what actually counts as investment income, because this is where people get so confused. The IRS is looking at what we call unearned income. This includes the interest you earn on your high-yield savings accounts, the dividends from your stocks, the capital gains when you sell a mutual fund or shares of stock, and the rental income you receive from investment properties. It even applies to passive income from businesses you don't actively participate in. If your total income crosses that $200,000 or $250,000 line, the IRS looks at whichever number is smaller, your actual net investment income, or the exact amount you went over the threshold. Then, they slap a 3.8% tax on it on top of your regular capital gains tax and on top of your ordinary state and federal income taxes. The fear here is real, my friends. The fear is that a single, smart financial move, like selling a property, rebalancing your investment portfolio, or taking a major distribution, can trigger a domino effect that devastates your retirement income for that year. It can even trigger higher Medicare Part B and Part D premiums through IRMAA surcharges. It is a double whammy, and it happens because people do not plan for the timeline of their income. But I don't want you to be afraid. I want you to be powerful. And you become powerful by taking action before the tax year ends. There are very specific, legal, and brilliant ways to protect your hard-earned money from this surtax. First, you must understand what income is safe. The IRS does not count regular wages or self-employment income toward your net investment income. Most importantly for retirees, traditional IRA distributions, 401k withdrawals, pensions, and Social Security benefits are completely exempt from the 3.8% surtax. They do not get taxed by this rule. However, and hear me clearly on this, those retirement distributions do count toward your total modified adjusted gross income. So, if you take a massive withdrawal from your traditional IRA to buy a boat or pay off a mortgage, you might push your total income way over the $200,000 or $250,000 limit, making every other dividend and capital gain you earn that year subject to the 3.8% penalty. Your first actionable takeaway is to embrace the absolute beauty of Roth accounts. Roth IRA and Roth 401k withdrawals are entirely tax-free, and they do not count toward your MAGI at all. If you are a few years away from retirement, look into doing strategic Roth conversions now. Yes, you will pay ordinary income tax on the money you convert today, but you are systematically lowering your future traditional IRA balances. By doing this, you ensure that when you are in your 70s and taking distributions, your income stays safely below the Medicare surtax thresholds. You are protecting your future self. Your second takeaway is to manage your investment gains with precision. If you have a regular, taxable brokerage account and you need to sell stocks to fund your lifestyle, do not just sell blindly. Look for opportunities to practice tax loss harvesting. If you have a stock that has lost value, sell it to offset the gains from the stocks that went up. By canceling out your gains, you bring your net investment income down, directly shrinking or eliminating your exposure to the surtax. Third, if you are selling a highly appreciated asset like a piece of real estate or a business, do not take all the cash in a single calendar year if you can avoid it. Talk to your financial professional about utilizing an installment sale. By spreading the payments out over 3, 5, or 10 years, you receive smaller chunks of income annually. This prevents your income from spiking into the danger zone all at once, allowing you to stay under the $200,000 or $250,000 limits year after year. Finally, consider where you are keeping your cash and fixed income. If you are a high earner or have a substantial portfolio, look into high-quality municipal bonds or municipal bond funds. The interest earned from these bonds is generally exempt from federal income taxes, and it is explicitly excluded from the net investment income tax. It is a safe haven for your income. My friends, retirement should be the time of your life where you reap the rewards of your decades of sacrifice. Do not let lack of knowledge allow the government to take more than its fair share. Check your income numbers today. Know where you stand relative to those frozen thresholds. Be proactive, be smart, and secure your financial future.